Good afternoon and welcome to the ASEAN Midday Market Watch. Our guest today is Jeff Halley. He's the Senior Market Analyst, Asia Pacific from OANDA. Hey, Jeff, great to have you on the show.
Thanks very much. Good to be here as ever.
Now, Jeff, I'm going to take a look at markets around the region, and then we'll get your insights because it is a sea of red across the region. But we will start closer to home with the ASEAN exchanges, and we will look at Bursa Malaysia, which is trading at 1,669.99. Now that's the exception. It's up 0.44%. The SGX is down 0.42% at 2,846.01. If we look across the region, the rest of the region is red. Nikkei is trading at 26,633.35. It's down 0.37%. Shanghai Composite is trading at 3,354.02. It's down 0.45%. The Hang Seng is at 26,218.6, down 0.65%. ASX 200 is down 0.24% at 6,644.5. And the Kospi rounds it up at down 0.69% to 2,743.10. Jeff, what do you make out of all of this? What's the reason that there's such negativity in the market?
Yeah, Malaysia's an outlier today. I saw that myself. It seems to have been led by Pertamina, oil staying firm, and also consumer staples have done very well there. So maybe there's a bit of rotation going on in that market today and low liquidity. Look, the rest of the region seems to be taking risk off the table. It's more consolidated, the price action. We have FOMC meeting starting today in the US and a rate decision that will come out early on Thursday morning Asia time. Also, we've seen no progress whatsoever in these US fiscal stimulus talks, although a new bipartisan document was produced today. Now, whether that can get past the Senate Republicans is another thing altogether. And then, of course, we've got countries such as Germany and London probably tomorrow all heading into hard lockdowns, probably followed by the Netherlands and Ireland in the next week or so before Christmas. COVID-19 rampaging across the US. New York is also looking to go back into a hard lockdown. So, there's a lot of balls up in the air, but nothing's falling to the ground. And I think what we're seeing now are just investors taking a bit of risk off the table and moving into a wait and see mode until we get a bit more clarity.
Okay, on the other hand of the spectrum, however, China is humming along. We've got China's industrial production numbers came out this morning. They grew 7% in November year on year, which was in line with expectations. Then retail sales were also up 5% year on year, which is slightly below expectation, but still a very good number. Now, what should we read into these numbers?
I think what we can read into these numbers is that China continues to lead the world in the COVID-19 recovery, and it will lead the world into 2021. The soft spot for China is its consumer demand. That hasn't recovered to the same extent that we saw industrial and exports recover. Although 5% today was only 0.2 off what the market was forecasting. So pretty good. And I think there'll be plenty of countries around the world who would like to see a 5% growth month on month in consumer demand at the moment. So,
yeah.
It's a matter of degrees, isn't it, really? I mean, these are fantastic numbers, but because it's China, we're going, maybe they're not as good as we're used to. So I think we take the positives out of this and not the very, very subtle negatives. China's recovery remains on track, and they will lead the world, as will the rest of Asia, out of this COVID-19 recession in 2021.
Now, moving on to Australia. Now, the Reserve Bank of Australia minutes from their December policy meeting were also released this morning and warned about an extended period of high unemployment, as well as subdued wage growth and inflation in the coming years. Now, how should investors react to this, and what should we be doing with our money allocated for investments in Australia? Especially, Jeff, we've been talking about this for a while now. There is a real disconnect. The markets are doing really well. Australia, however, is being hit by this trade war with China, but all the numbers so far are really good. So what should investors be taking out of this and all the events around, and where should we be putting their money?
I think what we need to keep our feet on the ground about is monetary policy. And what the RBA meeting minutes did say was rates will be lower for longer. They're not going to hike for at least 2 to 3 years. Inflation remains subdued. And although the COVID-19 vaccines arrival has upgraded the outlook for 2021, they are still saying that the world will face issues, which I agree with, and that they will do whatever it takes, which is a standard mantra that we see from the FOMC and the ECB and every other developed market central bank these days as well. The net result is monetary policy is going to remain ultra easy. In the developed world, rates will remain around zero. And in a 0% world, we're all looking for some sort of yield because we don't get it by putting it in the bank or buying bonds anymore. That is going to keep pushing up asset prices. So if you're allocated to Australia, as allocation to a part of a broader portfolio, I think that you won't suffer. I mean, stocks are going to rise everywhere. Sectors-wise, I think the banks are particularly well placed to benefit from a recovery. They seem bulletproof with this. Resource stocks have fallen a bit today because iron ore prices have fallen, but despite the noises that China are making, they're not touching iron ore exports because they can only get them from Australia and Brazil. Those are the only two places that they can get the volumes that they need. So the rest of it will be noisy and maybe a story for 2021, but I think we're going to see asset price inflation all through 2021, supported by 0% interest rates everywhere.
Now, Jeff, just still on the theme of Australia, I just looked up, and the Australian dollar is trading at almost a 2-year high. Now, obviously, on the back of this ramp up of iron ore prices in the last few months. Now, what's your outlook for the Aussie dollar, given the RBA statements and given what you've just told us?
Well, the RBA actually said in the meeting, in the minutes, that the Aussie dollar would have been a lot higher had they not cut rates and been ultra dovish. So to me, that says that they've accepted that that the Aussie will be higher. Remember, this is a weak US dollar story. It's not necessarily a strong Australian dollar story. But when you look at the commodity currencies, which are used as a proxy for the outlook for world growth, your Aussie dollars, Kiwi dollars, Canadian dollars, amongst the sort of G20 setup, they've all rallied very strongly. The Australian has actually not even risen as far as the Kiwi has, but it has outperformed. So I do believe we are going to see higher levels yet for both the Australian and Kiwi dollar, but also for Asian currencies. They're all sitting at either 2020 highs as well. As long as the yuan stays strong, which I expect, the Australian dollar and Asian regional currencies will also stay strong.
Now, Jeff, a final question. What data and policy statements around the world should we be looking out for the rest of this week?
Yeah, well, we've got quite a bit, Brian, actually. We've got obviously the FOMC, which will be early Thursday morning. But then in Asia, we've got shortly after that, we've got, I think, the central banks of Taiwan, Philippines, and also Indonesia, which will be very interesting. They did a surprise rate cut, I think, last month. I wouldn't put it past them again to try and slip another one in before the end of the year because the rupiah has remained quite strong. It hasn't fallen after that last one. So we have a bunch of central banks coming out on Thursday. Then I think we have industrial profits. No, sorry, we have the loan prime rate decisions in China on Friday, although I expect them to remain unchanged. So against the background of that, of course, we've got ongoing US fiscal stimulus negotiations. That deadline also comes at the end of this week, along with a bill to keep the US government actually going as well. It's a double header. So although it's not really data driven, there's a lot of event risk around there. And I believe this is why investors have taken some money off the boards today and yesterday, and why we're seeing equities just dribble a little bit lower because of that.
Hey, Jeff, thanks for your insights and your time.
Always a pleasure.
We've been speaking to Jeff Halley, Senior Market Analyst at Asia Pacific at OANDA. on ASEAN Midday Market Watch. I'm Brian Fernandez. Check out www.biztech.asia for business and technology conversations. Please subscribe and like our Facebook and LinkedIn pages. And thank you for watching.